So we have this special category of asset called listed property. Listed property essentially is any property that could be used for personal purposes at the same time that it could be used for business purposes. And really, it's, for the most part, it's confined to automobiles, because you can have, so you have a car that you use in your business. Well, you could also be using it personally for your own personal vehicle. So you've got some personal portion, you've got some business portion. Passenger automobiles are included in here. Any other property used as a means of transportation. Taxis are not included though. So where the vehicle is the source of income, but this is something that you use in the business as transportation. Also, any property of a type generally used for entertainment, recreation, or amusement, such as a boat or an airplane or something like that, includes photographic, phonographic, communication, and video recording equipment. So communication, so cell phones. People use their cell phone partially for business, partially for personal purposes. A cell phone would be considered a piece of listed property. There are special rules for listed property. All of those rules that we talked about with the maker's depreciation still apply, but the listed property has to be used predominantly for business. So more than 50%. So if you have a car that you use in your business and you also use it personally, and say you drive 10,000 miles during the year, 5,001 of those miles needs to be for business purposes in order for you to be able to use those maker's rules. So what happens if a taxpayer, if the use falls below 50%, then we can still use it as for business purposes, but we can only use straight line depreciation. We can't use that accelerated depreciation, and we can't use Section 179 expense on it. So we're not able to do that. So here, this is a really poor example because this person is an employee and none of this asset would be deductible to her because she's an employee. You have to have a business in order to depreciate any of these items. So if the listed property does not meet the predominantly business use test, which this is what that predominantly business use test is, the taxpayer cannot claim 179 expense, and you have to use straight line depreciation. Usually it's over a 5-year recovery period. So what happens as well is you have to recapture that same concept. You have to recapture the accelerated depreciation that you had taken on it. This is once it falls below 50% business use. So maybe the first year that you have it, it's 75% business use. Second year, it's 60% business use. But the third year, it's 40% business use. Well, in that third year, you're going to have to change how you depreciate it, and you're going to have to recapture any additional depreciation you took in those early years. So Jack purchased a large screen for video conferences. Right, so this would be under listed property. He purchased it for $2,500 for use in his home office. He's self-employed. He uses it 70% for business, 30% for his children to play computer games. So 70% is business use, 30% is personal use. He only gets to depreciate 70% of that $2,500. The rest of it's personal. He doesn't get to depreciate that. Because the screen is predominantly used for business, is 5-year property, the maker's depreciation for the first year would be $350. So how you would calculate that, the $2,500 times the 70% business use times the 20%. So we're going to, that 20% comes from the tables. Okay, that's where that 20% is coming from. So it's 5-year property, it's probably what, half-year convention. I would assume it's half-year convention. They're pointing to table 6A. So from that table in the first year, the basis of this property is 70% of the 2,500. That's the basis we would use, and then we would look up the percentage from that table. That happens to be 20%. So in the first year, he gets to take a depreciation deduction of $350. If the business use were only 30%, he'd have to use straight line depreciation. If he's using straight line depreciation, so we take the $2,500 basis times our business use. So this is 30%. So 750 now is our basis. This is what we're going to use to depreciate. We would then multiply that by, let's see, so if we're going to have to use straight line depreciation, so it's over 5 years, right? So that is what, 20% a year. But the first year, we can only take half of the depreciation, 10%, because we're using the half-year convention. So divided by 2, 10%. So 750 times 10%, $75 in the first year. That's because it was less than 50%, so he's got to use the straight line depreciation. Again, we're using 10% because we can only take half of the year because we're using that half-year convention. So we would start depreciating it July 1st. Normally we'd get 20%, we're going to get 10%, so that's the depreciation deduction if it's below 50%. So that's the difference between that's the difference with listed property. So if it can be used, it would have to fall, it has to be specifically listed property so mostly passenger vehicles and anything that can also be used for entertainment purposes, that is considered to be listed property. So if in the first year the asset's life, that 50% test is met, but in following years, the business use falls below 50%, the depreciation has to be recalculated using the straight line method, and depreciation must be recalculated for all years in which makers was used, and you have to recapture that additional depreciation that you took. So for example here, in this case, so if it fell to 30% and he's only getting $75 of depreciation in the first year, if he started out with it being over 50% and he took, what was the first calculation? He took $350, but then it fell below the 50%. Now he's going to have to go back, and like if this is year 1, so 50% plus use was $350. So he took a deduction of $350, but he was really only entitled to $75. Now he's going to have to go back and add that, what is it, $275 to his income and recapture it. So he has to recalculate all of that. All right, so that's what the recapture is. So here's an example. So assume the same facts. Business use was 70% in year 1, 30% in year 2. Depreciation and recapture amounts are calculated. So in year 1, they've got $350. Why do they have $175? I thought it was $75. First year. Oh, I guess if he was able to depreciate 70% of it, that's the difference. So they're using the basis of 70% of 2,500. But then it fell to 30%. So straight line, you do a comparison. So you see what you took, compare it to what straight line would be, and then you've got to take back any additional amount. So that 175. So the depreciation deduction would be $150 in year 2. the excess depreciation that was taken in year one now has to be included in income. It'll be included in year two income because it didn't fall below 50% until year two, but you got to bring that back and include it in income. So you still get this deduction because you still have the property, but now you're going to have to add back the 175 that you took additional that you took in that first year. All right. That's listed property. Again,